This is your Wall Street wake-up call. It's the first trading session of August. Will stocks maintain July's momentum? Let's ask Josh Mahoney now, a market analyst with IG Market based in London. So Josh, it's nice to see you. The S&P 500 rose 3.6% in July and on Friday closed 2 points away from its record high. How would you characterize the markets right now?
I would say entirely focused on what's happening from a monetary policy standpoint. I think if you look at earnings season so far, I don't think it's been particularly impressive. The one area that's really outperformed in the US has been the banks. And that really comes off the back of a really shocking start to the year. And really, they're just making up the ground year on year. They're not particularly doing that well. So I don't think that the US economy is in a great position because of the fact that we've got a stronger US dollar. We've got a lot of companies that are going to be worried about a continued slowdown. And therefore, really, the focus isn't necessarily on company strength. I think the focus is more on what's going to happen from a monetary policy standpoint. Are we going to see further rate hikes this year from the Fed? Unlikely, and if we do, it's going to be very slow. And then what's happening elsewhere? What's happening in the Eurozone? What's happening in the UK? I think that the position ever since that referendum has really shifted back a few steps, and now we're looking more into a sort of easing mindset, and that really is good for stock markets, if not anything else.
So would you say last Friday's weak GDP print was actually good for stocks because now perhaps it sets the stage up for a delayed rate hike, although we did have New York Fed President Dudley in a speech today sort of echo the Fed's statement last week and that we should see one more rate hike this year.
Yeah, exactly. It's always difficult, ultimately, are we sort of good news is good news or good news is bad news and reverse? What I would say is that when you hear different comments from different people at the Fed, it's always been the same thing all throughout the year. They're constantly talking up this idea that they're going to get 2 rate hikes within the year. And then once that is pretty much out the window and everyone's saying we're not going to get any, now they're talking up the idea that we might get 1. That's what they desire. I have no doubt about that. But ultimately, there always seems to be something that gets in the way, whether it be the Chinese slowdown, whether it be a stock market sell-off, whether it be a devaluation of the US dollar, whether it be the Brexit. There's always something that seems to stand in the way of what's happening over in the US at the Fed. At the moment, like you're saying, the GDP figure really sort of shows there's a continuation of this downtrend in GDP. The last 2 years, GDP has been on a continuous downtrend in the US, and that's not really showing any sort of signs of letting up. Business investments down, residential investments down, government spending down 1% as people are sort of moving away, or the government's moving away from spending in military. So I do think that, the US is slowing at the same time as we are elsewhere. Certainly the big fear is what's happening in the UK.
Right.
But the US certainly is outperforming. I just wouldn't necessarily think it's doing all that well for them to actually start raising rates at a time when, quite honestly, it's quite worrying what's happening in terms of the UK and what kind of knock-on impact that's going to have elsewhere. And, of course, You've still got the Chinese story as well.
But if this is a central bank-obsessed market, how do you play it? I mean, where do you find opportunities?
Well, look, you've got to try and play the differentials in my mind, and also I prefer to get involved in the sort of FX markets. If you look at the differentials between what's happening from a monetary policy standpoint with the likes of the UK and compare it to pretty much anywhere else, nowhere else is going to have the same kind of shift in sentiment around what's going to happen in terms of monetary policy than the UK, because we were going from a position where we were aspiring, certainly, to be raising rates. We're now going into a position where markets are pricing a 98% chance that we're actually going to see a rate cut on Thursday. But more than that, we've got a governor that doesn't actually believe in negative interest rates, and that means that we're near enough don't have the chance to do much rate cuts before we start going on to QE. So QE seems like a foregone conclusion to me, and as such, that's got to be good for UK stocks. That's also got to be bad for the pound. So I think that's how you'd play it. I think the differentials in terms of how we've seen big shifts really points towards the UK.
Yeah, and that Bank of England meeting is this week where we might get a rate cut. All right, Josh Mahoney from IG Market in London. Josh, thank you.
Thank you.
I'm Scott Gam, and you're watching The Street.